Welcome everyone. Thank you so much for joining. If you haven't already, please consider subscribing and make sure that you ring the bell to turn on video notifications. Starting in 2026, a quiet but significant change is coming to the way Americans save for retirement. For decades, workers over 50 have enjoyed the option to make extra catch-up contributions to their 401k plans, helping them boost their savings as retirement gets closer. But under new federal rules, that popular tax break is about to change in a big way. The rule comes from the Secure 2.0 Act that was passed by Congress. While the law includes dozens of retirement-related provisions meant to, as the Congress refers to it, modernize savings plans, one specific change is causing a stir. Starting in 2026, any worker, anyone who earns $145,000 or more in the previous tax year will no longer be allowed to make their catch-up contributions on a pre-tax basis. Instead, those contributions must go into a Roth 401k. That is a big deal because it changes when you pay taxes on your retirement money, and it also takes away a tax break from you. With a traditional 401k, contributions are made before taxes, so you get an immediate deduction effectively, which lowers your taxable income today. You only pay taxes when you withdraw the money later in retirement. But Roth contributions work in reverse. You pay taxes now, so the government collects their share of revenue right now as soon as you pay your taxes, and then you enjoy tax-free withdrawals in the future. With the time value of money factored in, of course, Roth contributions look a lot less appealing than traditional 401ks. So for those who make $145,000 or more, this new rule means losing the upfront tax break that's been a core benefit of 401k savings accounts. Starting in 2026, if you want to make those extra catch-up contributions, you will have to pay taxes on that money first, and then you will be allowed to make your catch-up contribution. Here's how the numbers break down. In 2025, for comparison purposes, workers under age 50 can contribute up to $23,500 to a 401k account. Those aged 50 and over can make an additional contribution of $7,500 in catch-up contributions, bringing their total limit to $31,000. For those between 60 and 63, the catch-up limit will rise to $11,250 under new inflation adjustments. But once 2026 begins, if you earn more than $145,000, all of that extra money must go into a Roth account. This may sound like a small technical change, but it has wide-reaching implications. For one, it could complicate life for workers whose employers don't currently offer Roth 401k plans. In those cases, employees might not be able to make catch-up contributions at all until their employer adds that benefit. And of course, that is a problem, especially for people in their 50s who are effectively racing to boost their retirement savings after years of focusing on other financial priorities like paying off mortgages or helping kids with college. The IRS has said that most large employers are adapting quickly. That, of course, should be taken with a grain of salt because they are referring to large companies. And according to the Wall Street Journal, 95% of 401k plans managed by Fidelity already include a Roth option, up from 73% just 2 years ago. Vanguard now says that about 86% of its plans offer one, but that still leaves a portion of the workforce, particularly those at smaller firms and self-employed, who may be left waiting. Critics argue that this new rule effectively amounts to a stealth tax increase, which it is. By forcing catch-up contributions into Roth accounts, the government collects tax revenue upfront rather than decades later. Supporters of the new law actually say that the change promotes long-term financial health by encouraging more Americans to hold tax-free assets in retirement, and that it helps balance the federal budget over time. So which group do you believe makes a better case? Let us know in the comments. As always, I would love to hear from you. Still, for individuals nearing retirement, the timing does matter, and that's what I would like to draw your attention to next. Many rely on the tax deduction from traditional 401k contributions to reduce their annual tax bill. Losing that benefit could mean thousands of dollars more in taxes owed every single year, and that's the money that could have been invested for future growth. The broader question is what this signals about the direction of U.S. retirement policy. The Secure 2.0 Act was designed to expand retirement savings and to simplify plan administration, but it also shifts some of the financial burden forward. For the federal government, that means more tax revenue sooner, and I would argue that collecting revenue now is the only benefit that this new law offers. And it doesn't benefit you or I, it benefits the government. For workers, it means paying now for tax-free benefits later, decades later. According to statistics, about 1 in 5 Americans aged 45 to 54 earn over $100,000 annually, meaning millions could eventually fall under this rule as wages rise. For those individuals, understanding how to optimize between traditional and Roth contributions will be crucial. It will be wise to begin preparing right now, I would say. Look at your employer's Roth options, estimate your tax exposure, and then just adjust your savings strategy before the rule takes effect. In the end, this isn't just a technical tweak, as you can tell. This is a policy shift. The government is nudging workers toward post-tax retirement savings. For some, that could mean greater flexibility and tax-free withdrawals in the long run, but for others, for millions of people, it feels like losing a valuable tax advantage right when they need it the most. So as 2026 approaches, every worker over 50, especially those earning above $145,000, should be paying very close attention. The rules of retirement savings are changing, and there may be more changes next year, and how you adapt could make the difference between a comfortable retirement and an expensive one. So stay tuned for new updates. I upload new videos on a weekly basis. Remember to subscribe, enable notifications by ringing the bell, and I will see you back here soon. I hope you have an amazing day. Take care.